Caught up earlier with Stephen Nash from FIIG Securities, and he said in terms of the German bond auction, it wasn't a disaster. It wasn't all that disastrous. Let's take a listen to that earlier.
There is a bit of a silver lining to this auction result, in the sense that Germany has seen itself as being immune or stronger than the rest of the European nations, and that now it's seeing itself being drawn into the broader decline in industrial production and other factors that their reticence to come into the cooperative agreements has led to. I think that this may lead to more cooperation by the Germans. I think effectively we need some sort of bridge between this fiscal disunity we've got now and a fiscal unity going forward, and I think the ECB is probably one of the major institutions that bridge is going to be built out of. And that means that Germany is going to have to come to the party a little bit more here. And I think the auction result might stimulate that a little bit more.
It's harder than that though, isn't it? Because as we've been discussing earlier, it's not really in the mandate for the ECB to kind of move on, bring out that big bazooka. So even if Germany said tomorrow, and maybe we'll look into the idea, it's still not a magic bullet, in the time that it's needed, is it?
In terms of immediate fixes, no. But in terms of the short term, I think it's one of the options that needs to be explored in more detail, and I think the Germans, considering it in more detail, may allay some of the fears in the market right now. So, no, it's not an immediate fix. I don't think there are many immediate fixes here. Yeah.
Okay, Stephen, what about safe havens in this market? The Australian bond market, will it receive any extra attention given now? What would seem to be the safer of investment German bonds have been so unattractive, it would seem.
Well, look, what's been happening over the last few weeks is that we've had the Australian-US 10-year spread contract about 25-30 basis points. Why is that? Well, partly to do with expectations of further easing in Australia. It's also to do with the credit story, and the credit story is very positive. So we've got Australian 10-year bonds now at a record low, even lower than the crisis levels. Does that mean all the fixed income is really expensive in terms of yield? No, it doesn't. There's quite a lot of spread widening, so we're seeing some quite attractive offers of about 8 to 9% for a lot of corporate issuers right now. So,
what are you seeing as some of the better options then that are actually out there at the moment for investors?
Well, some of the recent issues are I think, reasonable for retail investors, although the Origin deal might be a little bit expensive from a wholesale perspective. From a retail perspective, 400 to 500 over is what people are looking for, and in the fixed income market there's lots of offers out there, so I think people have to consider those in a little bit more detail. They're very happy with that 8 to 9% return in this environment. So 8 to 9% in the old days used to look low, now it looks really attractive, so I think that's what people are going to focus on.
But then again, what are you finding people are interested in taking up options at all at the moment? Even when you get the Chinese manufacturing number come through and just raise more concerns about Australia being more directly impacted, just a general interest in various products, are you finding that just waning?
Look, at this stage, the interest in fixed income just seems to be building all the time. It's very consistent, and I can't see it moving away. I think the asset allocation people have been caught out with a little bit too many equity exposures, and they're just looking generally at beefing up that fixed income so they get an offset. I mean, we've seen the government bond prices rise consistently through this crisis, and it just shows the benefits of fixed income in your portfolio.